Lately, there's this dividend ETF that's taking the Singapore market by storm because it invests in quality banks like DBS, UOB, OCBC, and then pay quarterly dividends with 5% dividend yield per annum. What is the name? Lion-OCBC, Securities, APAC, Financials, Dividend Plus ETF. What a mouthful. Okay, but anyway, before you go all in because it's a bank stocks alternative, you need to watch this video where I'll do a quick review of the features and the potential drawbacks you need to know. So grab your drink and let's dive into this video together. Okay, so there are three main features we need to know. Okay, first of all is the focus. All right, they focus on investing in the 30 largest APAC financial institutions or so-called banks lah. And then moving on is the quarterly distributions, which they will do a 5% of the issue price. So the issue price is $1, they will pay a 5 cents distributions. Okay, this is for the first 2 years. And the last one is growth. So they invest in the bank sector, okay, the financial sector, and they are potentially looking to grow their ETF share price in future as well. Okay, so why the financial sector and why APAC, okay, Asia Pacific itself? There are three good answers that are provided by the ETF. Firstly, financial services is the most profitable sectors in the world with a mouth-watering 18% net margin. Okay, this is across the different industries. And on top of that, 55% of adults are underbanked in the Asia Pacific region as opposed to when you talk about maybe US is 27% only and the Middle East is even lower than Asia Pacific itself or at 43%. Okay, so there's more room to grow in APAC. And secondly, with higher profit margins come higher ROE. Okay, so you can see they also have the ability to pay stable dividends. And from the chart over here, you can see that the APAC banks have paid increased dividends throughout the years. All right. And lastly, they say that the ETF is at an attractive entry point right now because of the low, the forward PE ratio of 9.5 times, the trailing PE-B ratio of 1 times. But notice there's somewhat like a disclaimer over here, right? So they mention that the growth catalysts are long term and they take time to be priced in. Basically, what the ETF is saying is that this is a long term kind of investment. You can't expect a strong, like a total return in a very short amount of time. And if you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel, and ring the bell so you get notified every time I release another stock analysis video. Next, let's take a look at the 30 stocks inside the ETF. So Lion Global has been very nice putting all the 30 stocks inside a table format together with their weightage as well. From the onset, we can already see that we have three of our favorite local banks inside the ETF with the highest weightage. And then, apart from that, right, just looking at the top 15 stocks or the left column itself, I do see that the ETF is rather big on countries like Korea, all right, Japan, and even Australia. Okay, so now let's take a look and zoom in, okay, on this some of these stocks to get a clearer picture. The biggest Korean bank inside the ETF is none other than KB Financial, which the share price has been the highest in the past few years, or rather more than 10 years, right? With the yield of 4.4%. And the next one in line is Japan Bank called Sumitomo Mitsui, okay, and it exhibits a similar pattern at all-time highs with around a 3% dividend yield. And last but not least, we have Commonwealth Bank of Australia, and it's also the same thing, right? 5-year high and pay around 4% dividend yield. So you can sort of notice a pattern here. How can the ETF pay out a sustainable 5% dividend yield if the stocks inside are not giving that kind of yield? So I see two ways of it happening, right? The first one is that if you zoom in on other stocks like the Hong Kong stocks, for example, ICBC and China Construction Bank, you can see they pay much higher distribution yields, like the one here, 8% and 8.7%. Okay, so this is the thing about it, right? If you have a diversified ETF, they net off each other to give a more medium yield of 5%. Okay, and if worst comes to worst, right, the distributions will actually be carved out from the capital of the fund to pay you. Assuming the fund size is 80 million, if it grows up to 100 million, maybe in the third year onwards, and the dividend yield, right, there's a maybe a 1% shortfall, so they can only pay up to 4% from the stocks income itself. So what will happen is that the fund will take out this 1% shortfall from the fund capital of $100 million. So you can see from here is that they can pay out the 5% either from the income they get from their stocks or the capital gains uh, along the years, right? Or a combination of both. With that, here's my take on the ETF with both the pros and the cons. Okay, so pros itself is a stable 5% yield. Okay, no headache or whatsoever. So the financial sector has been deemed as a very the one with the highest net margins and the high ROE. So they can also pay out attractive views, okay, of this 5%. And on top of that, this ETF is riding on the Asia Pacific growth. So they are serving the 55% underbanked. So in future, there may be more room for growth. On the other hand, we have the cons, which is this ETF is actually giving a 5% yield, but it's lower than what you will get from the usual REITs or even the, like for example, DBS itself, giving more than 6%, right? 6 to 7% dividend yield. And this is only looking at one particular sector, okay, the financial sector. So this is also impacted by the economic growth or slowdown or even the interest rate changes. So you have to be aware of this. And most of the stocks inside the ETF are trading at 5-year highs or like even all-time highs, right? So growth, or at least in the near term, right, may slow down. So this is something that we should take note of as well. And last but not least, right? Okay, by the way, this video is not sponsored, but if you are keen to get the ETF, I think especially if you are like a retiree and you think that getting a hassle-free 5% dividend yield makes sense for you, okay, you can check out all these dealers here. Okay, or you can also get it from the OCBC ATM itself. All right. And if you are a OCBC Voyage customer, you can actually approach my stock reminder Sandy, and you will get 12,500 miles for every order of 150,000 ETF units. Okay, I have put down her LinkedIn profile down below in the description box. I'm doing her a favor because she's been very nice. In getting me started when I'm still a newbie in the stock markets as well as CPF investing side. Before we end off, if you find the video helpful, I would appreciate it if you can help me to tap the like button and share the video so more people get to know about this video. Next up, don't forget to check out this video over here if you have another few minutes to spare. And I will see you next time. Thanks for watching and ciao.